what crypto continues to experience, because we talked about this before, the October 10th reset and all of that. I don't know if that applies to Ether and kind of where it goes from here.
We're still feeling the ripple effects. It crippled many of the key players in the industry, some exchanges and market makers, and so the industry is sort of limping along, but the fundamentals have improved a lot. And I think even Davos really amplified that Wall Street is now starting to view traditional finance and tokenization and blockchains as one business that's converging. And it's not just Larry Fink, but it's the UBS CEO, Standard Chartered CEO, that really Wall Street is on board. So I think crypto prices aren't quite keeping up with fundamentals, but as you know, when fundamentals go up and to the right, prices eventually follow. Then they're using capacity that could be used to buy other risk assets, whether it's Mag 7 or cryptocurrencies. But because crypto inherently has delevered, then that's going to be felt more in the crypto space. So I think crypto, which should be going up on like weaker dollar, easing Fed, it doesn't have the leverage sort of tailwind. And as long as gold and silver are rising, then there's a FOMO into buying that instead of crypto. But of course, that is just a leading indicator, right? Because when gold and silver take a break, then, and in the past, that would lead to a Bitcoin and Ethereum surge afterwards.
As investors prepare for a bullish February and March, Raoul and Tom Lee affirm that Bitcoin and crypto prices are about to go parabolic. They have an urgent message for people selling Bitcoin and Ethereum, as 2026 is now poised to see more all-time highs. As this momentum is building, the institutions are quietly positioning themselves, and Powell and Lee say everything is about to change, with Bitcoin's current price sitting just over $88,000, while Ethereum hovers just over $3,000 after a strong run. With the next bull market, and with crypto and technology being the biggest investments this year, Raoul Pal and Tom Lee remain bullish on digital assets and give a portfolio update, identifying the crypto assets poised for substantial growth in the coming months. With major pension funds and institutional investors on board for the coming cycle, Raoul Pal predicts that crypto is on track to be a $10 trillion digital asset class. Pal says that this cycle will separate itself from its predecessors, as devalued fiat currencies will push more adoption into the crypto market and bring in more capital than we've ever seen before. Let's get right into the interview with Raoul Pal and Tom Lee, as they give their market predictions for the days and weeks ahead. Drop your comments down below and subscribe if you enjoy the content we do here.
Last year was a year where everyone was, including myself, was expecting more liquidity. It tends to come in seasonal phases. Liquidity is generally being used to debase the currency to pay for the debts, and particularly the rolling of this massive debt load. That had been a 4-year cycle, and then last year it started. We didn't see the pickup in liquidity we're expecting, and that led me to try and understand what was going on, why it had changed versus my forecast, and I realized that the debts had been extended by another year, so therefore the cycle was probably a 5-year cycle. Okay, so that gave us an understanding. We should have still had a good end to the year. Normally, Q4 is good in crypto, or at least November, December is, and it wasn't. It was the opposite happened. And that was based on, again, liquidity, because we had the government shutdown. And the government shutdown, well, it first started in July, where the Federal Reserve, planning for the potential shutdown, started rebuilding what's known as the Treasury General Account. When they do that, they're taking money out of the system. So we had this liquidity air pocket. Okay, that's pretty normal. These things happen. Then we had the shutdown. Nobody expected the longest shutdown in history. Certainly I didn't. And what you got was a decoupling of crypto, which is the furthest end of the risk curve, because it got hit by this lack of liquidity because nobody could spend any money in the government. So liquidity wasn't there. That caused October the 10th. October the 10th was a crypto-specific event where everything broke basically on Binance and a few of the Asian exchanges, and everybody got liquidated in the largest liquidation event in history, and the market has not recovered from that yet. There's a bunch of theses why it hasn't recovered yet, but it's repairing itself, which is why we've had this choppy sideways price action for a long time, while other assets have been screaming to new highs. So does it mean that it's over and the 4-year cycle's over? No. because we can actually forecast liquidity. We do it a number of ways. One is look at financial conditions. They're weakening, and the dollar at a new low for this cycle today is a huge indicator that financial conditions are weakening. Bond yields over time have been either stable or trending lower. That's another input to liquidity. Commodity prices are starting to pick up. Financial conditions are improving. That leads global liquidity. And that in itself leads market prices. So looking at global liquidity, we know it's going to go up. We also know that the interest payments on the debt are still going vertical, so we can tell how much they have to roll. And they've got about 8 trillion to roll this year. So somehow you need to find 8 trillion. So what we've seen is a battle between the central bank and the government. Basically the rights to who debases the currency. Because if the central bank does it, they're not necessarily going to do what the government needs to issue more debt, because the government wants to spend money, give fiscal stimulus, do what it wants to do. And the Federal Reserve will say, well, inflation and unemployment, we're not going to do that. The other thing is, what happens is the banks use leverage and create more liquidity. So banks can create money too. And this process allows them to take more risk, add more leverage. So this is the way they're going to start financing this. We've got a bunch of other measures coming through, but that's the main one. In addition, what this does, it picks up the business cycle. We've seen this K-shaped economy where Main Street is basically in recession or near as damn it to a recession, while Wall Street has had a boom. And that's because the ISM, the business cycle, the Institute of Supply Managers survey, is still below 50. So they know they want to win an election. They need Main Street to feel like it's got money and it's feeling like the economy's growing. So it is mirroring these financial conditions which are loosened, and eventually crypto plays catch up. There's still a bit of a dislocation between crypto prices and global liquidity because of what happened in 1010. But when you look at all of this, the probability is that those alligator jaws, the difference between, let's say, global M2 and crypto, or gold and crypto with the lag, all of this, all close. So that's what I think is about to happen. We've had similar in the equity market. It was called the flash crash in 2014, I think it was. And big stocks traded down 80% in like 3 minutes. Yeah. Exactly the same mechanism. And there was a break in the market. Did that stop the equity bull market? No. Did it take a while to digest the mess? Yes. They had to cancel a bunch of trades, and a lot of people had lost money in it. It just takes a while.
Raoul says it's the fastest pace of adoption of any investable asset in all of human history. By the end of 2026, there will be 1.1 billion active crypto wallets. The pace of growth is hard to comprehend, and it will be the fastest accumulation of wealth we have ever seen. This is the conclusion of a career's worth of research. And every single chart and piece of research leads to the same conclusion. Liquidity drives everything, and crypto will be the best performing asset of them all. Raoul has been stressing to investors for months that all the factors are beginning to align right now, a period characterized by parabolic moves upwards in crypto prices.
So when you give the banks the ability to leverage up, they'll lend it to small businesses. They'll create economic activity, which central banks don't create economic activity. They just debase the currency by using the balance sheet. But the banks debase the currency and create economic activity. That's why they're doing this. So really, I'm using the macro framework of financial conditions leads liquidity. Financial conditions is there as the lead into the need for debasement of currency via liquidity. That's driven by the interest payments on the debt and the debt that needs to be rolled. So it's all a macro thesis that rolls down through asset classes. And it rolls down according to the business cycle, where you've got some assets that lead, some lag. Gold leads currently. So it's not about gold, it's about the business cycle. Gold is just an easy way of looking at it. And in fact, if you put the charts of Bitcoin and gold with I think it's a 180-day roughly lag, they actually match up very well. But what you found is you've got this slight alligator jaws, and the alligator jaws is the impairment of the market that's only in crypto. So therefore, it's a temporary state of affairs, most likely. And you see, if the market starts performing better again, almost everybody in crypto is underweight now, because half the market thinks the bear market's in play and the cycle's done. And if the market starts ripping from here, everybody's kind of underweight, so they'll chase it. I really think that unless there's something extraordinary, another government shut down and it's something extraordinary happens, really by the end of next month, we should start seeing much higher crypto prices. It's coming to that point now, because if you think the election's in November, they have to get the ISM from 47 to like 55 or 57 in the shortest period of time. They're going to give out massive fiscal stimuluses. They're giving tax breaks, and they're giving the banks the ability to use more leverage. That should start flowing, unless something is astray here. Now, could it be something to do with the tariff thing? Possibly. There's always something that can go wrong. There's nothing as a certainty. Everything is a probability, and there's always an unknown that comes into play. Could be a positive unknown, could be a negative unknown. The flip side of that, we've got the Stability Act. Does that get put through? We don't know. I mean, last week, I had a call with some of the people in the US government, and they're like, if we don't get this through now, it's not going to go through for 6 years. The guys from Bitwise have talked about this. It unleashes a lot of capital because it really gives clarity on what is what. And a lot of people, particularly the banks and the asset management firms who are creating products in the space, really need to know this. So that's the thing the market's going to get scared of next. And when and what, I don't know. We've got prediction markets this time around, so it'll give us some better odds so we can understand this. Now, I don't think they'll want to raise rates unless we get an inflation problem, but they'll certainly slow the liquidity down because they don't need to roll debt in year one of a cycle. It comes later. They start in year 2, 3, and 4. Or 5 in this case. So we'll see. I don't know about 2027. I'd imagine it's a down year, but who knows with what's going on and how fast the world is moving. We don't really know. But we'll use the liquidity framework and assume that it'll work. It's really simple. Firstly, when you've got a network adoption model like Bitcoin, it actually works like Google and Facebook and all of these. They use Metcalfe's law as a evaluation model. And that allows you to predict network growth over time. And you just use a log regression channel, and you can map out the price of Bitcoin, because that worked perfectly for Google, Facebook. They've been in those channels. The NASDAQ has been in that channel since 2000. It's extraordinary, the power of these network adoption models. So they become pretty forecastable. Again, nothing is perfect. But if you put the Bitcoin market cap into a log regression channel and put it forwards, you get to $100 trillion by 2032, 2034, whatever. Let's call it 10 years. So so what must be true for that to happen? Simply, stable coins can add a huge amount of activity and therefore value to the network. Scott Bessent's already said within 3 years, they think they can get that to $3 trillion. So what multiplier effect does that have on the underlying? Because it's not $3 trillion of assets just stored. There's economic activity that drives the value of the blockchain. We've then got the asset management industry coming into this space, the banks coming into this space. We're then talking about tokenizing equities. We're talking about tokenizing fixed income. We're talking about tokenizing futures markets. We're talking about tokenizing all of these real-world asset big markets.
Powell stresses this pattern is normal and necessary to flush out weak hands and reset leverage. He highlights Bitcoin's high correlation to global liquidity, which remains supportive, even during temporary liquidity air pockets. He believes the market is setting up for another strong leg higher. Similarly, Bitwise CIO Matt Haugen supports this view, pointing to a dip-then-rip pattern, where sharp pullbacks are typically followed by massive rallies, up to 190% gains historically. Both argue that patience, not panic, is key. The banana zone is alive, just misunderstood. As the momentum in the crypto market is building and institutions are positioning themselves, Raoul Pal says everything is about to change. He says the next phase of the crypto cycle is critical, and he's stacking big bets in his portfolio right now. With the next bull market, and with crypto and technology being the biggest investments this year, Raoul Pal says that he's remaining bullish on digital assets after significantly increasing his position size during the last bear market. The former Goldman Sachs executive gives a portfolio update on which crypto assets have the biggest upside in the coming months. He says we're about to see massive capital pouring into the crypto space. With major pension funds and institutional investors on board for the coming cycle, Raoul Pal predicts that crypto is on track to be a $10 trillion digital asset class. Pal says that this cycle will separate itself from its predecessors, as devalued fiat currencies will push more adoption into the crypto market and bring in more capital than we've ever seen before. Bitcoin is one that is headed for an unprecedented price milestone, and Raoul foresees a financial tidal wave that will catapult cryptocurrency to new highs. Raoul Pal says the crypto world is on the brink of something massive, a seismic shift for Bitcoin and crypto in what he calls the banana zone. And that's where Bitcoin comes in. Bitcoin has been trading more like a risk asset lately, meaning if the market recovers, Bitcoin is expected to surge alongside it. But the uncertainty is key here. If the market remains stuck in limbo, Bitcoin could face short-term pressure. So we could see a sharp recovery in the next week. The bottom line, Bitcoin's next big move depends on how this plays out.